Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. It's been an interesting week in the financial markets.
And we have a long list of questions from our loyal listeners. Let's zip over to the Netherlands, where Bert Wenkenbach asks, and I hope I'm saying that correctly, the present credit bubble, that's hard to say, the present credit bubble, where credit is driving the financial world but not the economy, does remind me of the Japanese credit bubble that popped in 1989, back when everybody was turning Japanese, according to the song. Yeah. Japan has never recovered from it. If I remember well, Bob has visited Japan several times. Can he explain a bit more about the details of that bubble and the role that the Japanese industrial conglomerates played in this process? Japan has more of a planned than free economy market now, and also at that time.
Yep, Bert, thanks for your question. Yeah, Japan has spent a couple of decades proving that putting money, artificial amounts of money into a credit market doesn't prompt business activity. It's been a theory that's been around for a long time. But yeah, that Japanese bubble in 1989 was remarkable because it was kind of like 1920, where the rest of the world was speculating in commodities. Huge boom in commodities. Japan had a stock bubble, so that when 1929 came along, the rest of the world had had 1929, and the Tokyo market barely participated. I remember looking at it at the time thinking, this is really interesting. And indeed, the Japan market has had some rallies, but they haven't been huge. The huge one was back in 89, and at that time they had the formula. They had their planning agencies, I think it was called MIKI, M-I-K-I, and because their stock market was flying and the rest of the world's were not, their top agency was celebrated around the world. But what they were doing is there was all kinds of fancy option deals being done, such that speculative companies were getting almost zero-cost money. And this is at a time when nominal rates were still quite high. So Tokyo had their own fabulous bubble. The hot players were picking up what they call, trophy hotels or trophy properties around the world. And the guy who paid a huge price for the gorgeous resort at Pebble Beach in California, and 6 months later, or something like that, he was broke and burned out. So they were all using leverage. Yeah, and also, Bert, we do have colleagues in Japan that translate our research into Japanese, and so there were a number of trips to Japan, and we watch it closely, but not that closely. But I like the term when it was the game with the warrants way back when was called financial engineering, and in Japan it was called Zytec, and it means, well, financial engineering. And there's an awful lot of it going on around now in particularly in New York markets. I mean, the games that are being played are incredible. But Bert, thanks for the question.
We have a question from Butch. Butch asks, if the Democrats win the election, does Bob still expect the U.S. dollar to rise? I hear some investors talking about pulling money out of the U.S. if Biden wins, although I don't know where you'd put it. The whole world is nuts. Well, thank you, Butch.
Yeah, Butch, you got a good way of crafting a line there. Oh, the thought of Democrats winning is truly scary. Every election has always been important, but this election is coming down to very simple. Those who understand and appreciate the concept of government limited by an agreed upon constitution, or unlimited government going right out of control. I'm also going to add, without saying that it can happen in the States, but there's been 3 huge experiments in authoritarian government in the senior economy over the last 2,000 years. And one was Rome, and it was a relatively free market, and then it turned corrupt, and the state granted itself the privilege of state murder. Then the next one was also based on a huge amount of conquered wealth, and it began in 1500 with all of the gold and particularly the silver bullion coming from the New World, which launched another period of inflation and authoritarian government and a corrupt and venal bureaucracy, corrupted the fine tenets of the church. And eventually the governing classes granted themselves the privilege of state murder. Now that's when you're really a serious totalitarian. But the problem with authoritarians is that they have no limits. And this is where a constitution with limitation upon government ambition has always been a sound thing. But as to if the Democrats won, of course, immediately the dollar and financial markets would sell off. But then, quite likely, the financial markets would sell off after August, anyways. And but my mind just can't cope with the Democrats winning, and we just have to face it when it comes. But it was a good question, Butch.
And from Belgium, we have Frank asking a question. Bob, gold is setting record highs in many currencies and is challenging the 2011 high in U.S. dollar terms. Everybody's talking about the gold bull market, but I worry because gold is going up and down with the general stock market, because silver and mining is lagging this rally, and because gold gets so much attention. Is gold really going to save us when a post-bubble contraction panic sets in, or do we get a much better entry in gold after a panic phase?
Yeah, I think we want to talk about gold or gold stocks, so that's what we'll set it up with, Jim, is that, and we just did this one yesterday with the chart showing the gold stock index, GDXJ, relative to the S&P. And in every great financial bubble, of which the most recent may have ended in January, the real price of gold has gone down during the bubble, and with that, gold stocks have underperformed the big market, which really did happen from the huge bubble that concluded so dramatically and measurably in 2011. But we're just looking at like the last few years where gold's real price would have come down, and it did, and gold stocks would have underperformed the S&P, and that happened. And then you get the turn, and it's remarkably reliable that gold adjusted by the U.S. CPI the real price did come down into 2018, which is when many of the global bubbles in either credit markets or stock markets reached their best, and then it's been improving. The real price of gold has gone up strongly, steadily, and hugely, and this is confirming that history is now in a post-bubble contraction. And also with this, as I mentioned, we did the GDXJ divided by the S&P, and it was down in dismal until into 2018, and then by stages it has recovered, and the outperformance over the last 6 months has been outstanding. And this is also confirming that we're in a post-bubble contraction. Now, one of the problems in the gold market is that a lot of, we'll call them our inflationists or gold bugs, whose only understand that the Fed is crazy, which we agree with, and the dollar's going to go down, which we won't agree with. But their old formula is the old inflation game, that everything goes up in price and then you benefit, and gold is going to go to 10,000 and that sort of story. But no, history is telling us that gold is following a post-bubble contraction pattern. But the problem is you got all the inflationists all excited now, and perhaps gold stock prices, some of them have been outstanding, are kind of overdone. So this is where we're calling for a correction in the gold stocks based upon the technicals within the gold stocks. But also there's likely to be another phase of credit distress out there, which would break down the big stock market, and then that would put some pressure on gold stocks as well. So I think some of the ones that have been exceptional, and or there will be could be some other rallies by the time we get through August, where one could be taking some money off the table in the big market and also in the gold stocks.
We'll have more listener questions when Bob Hoye returns.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Bob Hoye. Kate's question for Bob. Silver bugs say that the price of silver is like a pressure cooker ready to explode. I assume they mean upward, but silver has already had an explosive run-up since the March low. In the 1929 equity crash, silver didn't bottom until early 1933 when the equity bubble burst in 2007. Silver did rise into early 2008, then crashed into late 2008. And then it took over 18 months to regain its 2008 high. Will silver decline in the next equity sell-off and possibly test the March lows? Assuming the silver pressure cooker explodes lower, could silver retest its longer-term support at $10?
Maybe a pressure cooker exploding lower is an implosion. Silver is an amazing metal, and the silver bugs are non-stop because every year they've got the fundamentals that there's more consumption than there is production. But nevertheless, the ratio between gold and silver is a long-running price series, like thousands of years. And it, quite simply, if you're in a boom and gold and silver prices are going up silver will always outperform, which was the case into 2011, and we by that time knew that the momentum on this is now silver-gold ratio with silver on top. When that momentum gets up to 90, it is overblown market, which we pointed out in April of 2011, and also pointed out that the only other time that RSI had been up to 90 was in that very fateful January 1980. So this was in 2011, and the signals were all over the place to get the hell out of the market. And then, so what you have with silver, to get back to your question, is that in a boom, silver goes up relative to gold, and in a bust, it doesn't. It goes down relative to gold. So I'm watching the gold-silver ratio, and if it goes up and breaks out beyond the last high, it was 115. And also I remember in last December, remember one of the silver analysts was looking at the gold-silver ratio and saying that at 87, it's far too high, and it's going to go down and silver will outperform gold, da-da-da-da. And our view then was that if it breaks above 87, it would indicate a possible crisis coming into the financial markets, which it did. But also, I guess it was early January, noted that if the gold-silver ratio breaks out, it could go, and then we just pulled a number out of the air to 115, which was shattering to the silver bugs at that time. But it did go to 130, so and that's the main thing. So rather than trying to trade silver off of supply-demand analysis, one should watch silver to let it tell you what's going to happen in the marketplace. And if the gold-silver ratio breaks out, actually there's 3 steps. If it gets very choppy and volatile in here, it will suggest a change in the big financial markets coming. And then if the ratio itself breaks out above the recent trading range, then that'll be saying that there is a credit crisis coming. And then within the credit crisis, silver will do one of those downs. And I think the gold-silver ratio can go back up to 130 again. So I hope there's some silver analysts that are listening to this.
Another question, this one from Steve about long-term treasuries versus gold. As the contraction continues, it's likely the Fed crazies might get crazier and follow Japan and Europe with the launch of negative short-term interest rates. In this situation, is it conceivable that long-term treasury bonds with positive rates outperform gold when short rates sink below zero?
Yeah, difficult to take short-term interest rates and gold prices because the conventional wisdom on it is that if short rates get too high, then there's more attractive returns from treasury bills, and then people go out of gold. But all I know is if you take a look at the real price of gold, it goes up in a post-bubble contraction, which earlier question we noted. And the other thing is that the real price of base metals heads down, which is happening. So silver is risky. One should have a portfolio of, and then also, that's right, now the relating to interest rates, nominal interest rates, is never too practical. But in a post-bubble contraction, real long rates go up, which means that the long bond future goes down, and also the real price for gold goes up. It's really backwards to what conventional wisdom goes on about, but we'll stay with our view that at the moment the interest rates are telling us that a recession was due, like the yield curve inverted last summer. And on our charts back to 1857, every curve inversion has been followed by a recession. So curve inverted, we are in a recession. So anyways, thanks for that question.
We'll have more with Bob Hoye when he takes a look at some headlines when we return.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, the U.S. Fed has assumed something like $3 trillion in pumping up the U.S. markets. What's this really doing? Is it really going to save the stock market?
I don't think so. This credit market began to change a year ago. Earlier in the year, you saw that Turkey and Argentina central banks suddenly ran out of reserves, so they had their little local crises. And then at about this time, it was India, and then China ran out of reserves. So our formula then is saying, okay, credit contraction would likely hit the U.S. in the fall. And then it was on September 9th, I think it was, when suddenly they discovered there was no liquidity in the New York money market at all, and that's when the Fed came in with their huge repo operations, immense amounts of money put in. And we were writing then that this was indicating how serious the credit crisis may be, or is, or something like that. So, but nonetheless, our technicals on October the 4th, a year ago, gave a buy on the stock market. So we figured it would rally to January. And if it was strong going into January, that could top the market, which it seems to have done. But it's all fitting in a pattern. And it may be switching away from the question, but it's a good wrap, is that if you look at the credit market, we have been in a boom where the yield curve and credit spread did what they're supposed to do in a boom. And then last summer, when they began to change, that was a potential cyclical change. And indeed, with the crisis earlier in this year, that locked in a cyclical change. Now, so what you have two things going on is a natural change in the credit markets to end a boom, in which case also the economy would have slowed immediately as well with the stock market. But on top of that, you had this extraordinary response by authoritarians around the world in shutting down economies. It never happened before. The economy in the U.S. and the rest of the world would have weakened anyways, but not to that degree. So anyways, the financial markets have had a great bounce out of the dismal March, and our work then in March was that once it turned, the rally could run till about mid-year, standard seasonal stuff. And then over the last 5-6 weeks, we have been getting technical excesses on the upside. So it goes back to our old question, is it up when it should be? Yep. Are there signs of speculation? Yes. And what happens when financial markets become too speculative? Well, eventually exhausts and rolls over. So we're now, like in August, we'll be starting to review that you can get seasonal weakness in crude oil after September down into January, and that'll take the stock market down. You also can have seasonal weakness in base metals down to about maybe November. And then the other industrial commodity that can be seasonally weak, and it's been strong lately, is lumber. And it can go down into October. So after August, we think that natural market forces turn down, and it'll take the stock market with them.
Headline, 10,000 day traders an hour are buying Tesla shares. What's behind this madness?
First of all, Tesla, I think, has been one of the greatest stock promotions in history. Absolutely outstanding controls on that market. On a thin story, but it's one that people ardently believe in. And then the other one you've got is an extraordinary event in the marketplace where many, isolated at home, started suddenly trading the stock market. And I was saying 10,000 day traders an hour are coming into the market and buying the hot stocks. And if you're on the long side at the right time, it looks like you're making money. But it looks to me like a whole bunch of new novitiate stock traders are in the market, and often they're not right.
Another headline that we're taking a look at, a string of bank runs in China fueled by rumors on the internet. What's behind that?
Well, yeah. People have suddenly decided they needed their liquidity, and don't know, the story didn't include that there were lineups at the banks to get their depositors to get their cash out. Now, that was always a classic image, going back as far back as you want to, where suddenly depositors want their money out. And then the game at whichever investment or commercial bank is involved is to put it out as slow as possible, hoping that the crisis ends. And of course, also in the 1825 crash, the same thing occurred with England, with the Bank of England, where they were slowly putting out whatever coinage they had, and then somebody found a box of 2-pound notes or something like that, and it sort of saved them. But runs on banks are classic, and I think the story on this one is, rather than seeing people physically standing at the door of a bank wanting to get in to take out your deposits, the rumors are sent around through the social media, the internet, and, I'm going to take my money out, kind of thing. So, again, it's another suggestion that a post-bubble contraction is underway. So,
Bob, thank you so much for chatting with us.
Well, it's been fun, Jim. We've had certainly a good list of questions. I think they were covering everything from silver to short-dated rates to long rates, and quite look forward to them.
And we encourage people to send their questions for Bob to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.